While Western media remained obsessed with China's economic slowdown and Beijing's property crisis throughout 2024, something extraordinary was unfolding across the Indian subcontinent that global investors completely failed to anticipate. Throughout the first 3 quarters of 2025, container ships loaded with electronics, pharmaceuticals, and precision machinery began departing from newly constructed ports in Gujarat and Tamil Nadu, heading toward destinations that had exclusively relied on Chinese manufacturing for over 2 decades. By September 2025, India's manufacturing exports to European Union nations crossed $47 billion annually, marking a 340% increase from just 3 years earlier. And here's the figure that should fundamentally change how Western corporations view global supply chains. Of the $89 billion in manufacturing orders that multinational companies pulled out of China following geopolitical tensions and supply chain vulnerabilities, Indian manufacturers have captured $52 billion in replacement contracts, with companies like Apple, Samsung, Tesla, and Volkswagen establishing production facilities at a pace that logistics experts are calling unprecedented in modern industrial history. This isn't about temporary cost arbitrage or short-term diversification experiments. This is about the largest manufacturing reorientation since China joined the World Trade Organization in 2001. And the infrastructure enabling this transformation was constructed while Western analysts were still debating whether India could ever compete with Chinese manufacturing efficiency. For nearly 3 decades, global manufacturing operated under one fundamental assumption that seemed unbreakable. China was the factory of the world, and no other nation possessed the combination of skilled labor, infrastructure, supplier ecosystems, and government coordination necessary to challenge that dominance. International corporations built their entire operational models around Chinese manufacturing capabilities, accepting supply chain concentration risks because alternatives appeared prohibitively expensive or logistically impossible. That assumption collapsed faster than anyone predicted. According to internal projections from McKinsey Global Institute obtained by multiple financial publications, if current relocation trends continue through 2027, India will capture approximately 31% of global electronics manufacturing, up from just 4% in 2020. The Boston Consulting Group estimates that India's share of pharmaceutical manufacturing for Western markets will exceed 45% by 2028, fundamentally restructuring an industry that China dominated for 2 decades. So India made a strategic choice that Beijing never anticipated. Instead of competing directly with China on existing manufacturing categories where Chinese suppliers had decades of advantage, Indian policymakers and industrial leaders launched what they're calling the Production-Linked Incentive Scheme, offering subsidies exceeding $26 billion to attract manufacturing in sectors where supply chain vulnerabilities had created urgent demand for alternatives. The centerpiece of this strategy is semiconductor manufacturing, where India has committed $19 billion in government investment to build fabrication facilities that reduce dependence on Taiwanese and Chinese chip production. The numbers reveal a transformation that most Western observers still don't fully comprehend. In 2021, before this systematic reshoring movement began, Indian electronics exports totaled $15 billion annually. By October 2025, according to data from India's Ministry of Commerce, electronics exports alone reached $41 billion, with smartphones, computer components, and display panels leading the surge. Apple now manufactures 14% of its global iPhone production in India, up from essentially zero just 4 years ago, with plans to increase that share to 25% by 2027. Foxconn, the Taiwanese manufacturing giant that built its empire on Chinese production, has invested $7 billion in Indian facilities since 2023, employing over 180,000 workers across multiple states. Samsung operates what industry analysts call the world's largest mobile phone factory in Noida, producing 120 million devices annually. And the geographic distribution of where these investments are flowing reveals the strategic depth of India's industrial planning. Gujarat attracted $31 billion in manufacturing investment during 2024-2025, with chemical, pharmaceutical, and automotive industries establishing integrated production clusters. Tamil Nadu captured $24 billion in electronics and component manufacturing, leveraging existing port infrastructure and technical education systems. Karnataka became the destination for precision engineering and aerospace manufacturing, with companies like Boeing and Airbus establishing component production facilities that previously operated exclusively in China or Southeast Asia. Think about what this represents for global economic power dynamics. For decades, China's manufacturing dominance gave Beijing extraordinary leverage over Western corporations and governments. When trade disputes emerged, when intellectual property concerns arose, when geopolitical tensions escalated, multinational companies had limited options because relocating production from China appeared economically unfeasible. That leverage is eroding faster than Chinese policymakers anticipated, and the implications extend far beyond individual corporate decisions. According to analysis from the Peterson Institute for International Economics, the manufacturing exodus from China represents approximately $180 billion in redirected investment since 2022, with India capturing the largest single share of that relocation. Vietnam absorbed $34 billion. Mexico received $28 billion for nearshoring operations. But India's $52 billion represents something fundamentally different, because the scale and sophistication of Indian manufacturing investments suggest permanent restructuring rather than temporary. Hedging. Here's what should concern Chinese economic strategists and excite Western policymakers watching this transformation. This isn't temporary adaptation to short-term geopolitical tensions. This is permanent infrastructure that fundamentally changes global manufacturing geography. Once Apple establishes integrated iPhone production ecosystems in India, once pharmaceutical companies build API synthesis facilities in Gujarat, once automotive manufacturers construct component supply chains across Tamil Nadu, those investments don't simply relocate back to China when political tensions ease. The sunk costs are too substantial, the supplier relationships become too integrated, and the operational knowledge transfers too deeply into local workforces. The International Monetary Fund's latest projections show India achieving 6.8% GDP growth in 2026, the fastest rate among major economies, with manufacturing contributing an increasingly significant share of that expansion. Indian officials are openly acknowledging what Beijing doesn't want to hear. The era of Chinese manufacturing monopoly is ending, not because China became less competitive, but because global corporations discovered that concentration risk in a single country creates vulnerabilities that no efficiency advantage can justify. The immediate test of this manufacturing transformation comes through the next 18 months as companies finalize long-term supply chain architectures. According to statements from multiple Fortune 500 executives compiled by the Financial Times, companies are establishing what they call China Plus One, or increasingly China Plus Two strategies that permanently diversify manufacturing across India, Vietnam, Mexico, and Eastern European nations. Once those supply chain architectures are finalized, once contracts extend across 5- and 10-year horizons, once specialized training programs produce skilled Indian workforces capable of matching Chinese quality standards, those decisions become irreversible features of global manufacturing. Even if U.S.-China relations improve, even if tariff threats diminish, even if Chinese manufacturers offer substantial price reductions, the risk calculus has permanently changed. India represents 1.4 billion consumers, English-speaking technical graduates, democratic governance that Western investors trust, and geographic positioning that serves both European and Asian markets efficiently. And the infrastructure investments enabling this transformation were years in the making, constructed while Western analysts remained skeptical about Indian manufacturing capabilities, completed while Chinese officials dismissed competition from New Delhi as economically insignificant. The era of Chinese manufacturing dominance is ending, and it's ending because geopolitical tensions, pandemic supply chain disruptions, and strategic miscalculations by Beijing force global corporations to build the infrastructure and relationships necessary to escape a dependence they previously considered permanent.